Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
All right, we've got three big stories for you today. First up, we're digging into how a new breed of independent Chinese oil firms are pushing giants like ExxonMobil out of Iraq by slashing drilling costs to an unheard of $4 million. Then we're looking at the rise of algorithmic auditing, how companies like Hertz are using AI scanners to cut claims expenses by 30%, and why your hotel hairdryer could suddenly trigger a hefty fine. And finally, we'll explore why top analysts are betting big on companies like Varonis Systems and ServiceNow to dominate the new AI economy, with one firm getting a stunning $1,200 price target. A massive power shift is underway in the global energy market, and it's happening right under the noses of the oil super majors. While Western giants like ExxonMobil and Shell have been scaling back in Iraq, a new force is flooding in, winning one half of the country's new exploration licenses last year. These aren't the state-run behemoths from Beijing. They are smaller, hungrier, independent Chinese oil firms. However, if you zoom out, you'll see another layer of strategy at play. The rise of these so-called independent firms marks a huge evolution in China's foreign policy. While they operate like private companies, many maintain close ties to the state, essentially acting as a more flexible and deniable tool for securing strategic resources abroad. It's a new form of economic statecraft playing out in real time. And their goal is jaw-dropping to double their output in Iraq to 500,000 barrels per day by 2030. So what's their secret? They are playing a different game. They are faster, more risk-tolerant, and radically cheaper. Their strategy involves applying a lean startup model to the oil industry. They use streamlined management, innovative supply chains, and a relentless focus on cost-cutting to get projects moving at a speed that traditional giants can't match. They've driven the cost to drill a major development well down by one half to as low as $4 million. This has caught the attention of Baghdad, which is desperate to accelerate production towards its ambitious target of over 6 million barrels per day. An official at the state-run Basra Oil Company put it bluntly, stating, "Doing business with the Chinese is much easier and less complicated compared to Western companies." But this high-speed, low-cost approach comes with a major trade-off. Insiders are raising serious concerns about transparency and technical standards, worrying that Iraq is sacrificing advanced technology for rapid development, and that trade-off is critical. When we talk about advanced technology, we're referring to crucial systems with long-term benefits. For example, methods like enhanced oil recovery, or EOR, can boost the amount of oil recovered from a field by up to 15%, extending its life for years. We're also talking about environmental tech like methane capture systems. By bypassing these for cheaper, faster methods, Iraq might get oil now, but at the cost of leaving more oil in the ground forever and causing more environmental damage. It's a classic short-term gain for long-term pain scenario. It's a high-stakes gamble. Companies like Geojade Petroleum and Zhongman Petroleum are pouring in hundreds of millions, committing to build not just oil fields, but refineries and power stations. Which, of course, raises the question, where is all this money coming from for these supposedly independent companies operating in such a volatile region? This is where the lines get blurry. Research suggests that while they are risking capital, they may also be underwritten by Chinese state-backed financial institutions. This gives them a massive advantage and a safety net that Western firms relying purely on private capital simply don't have. This isn't just a business deal, it's a strategic realignment with billions of dollars on the line. The race for Iraq's oil is being rewritten at lightning speed, and as this new wave of players reshapes one of the world's most critical energy markets, there's a big question about the final price of this new era of dominance. Interestingly enough, part of that price is paid by the local population. Iraq's own rules often require that 85% of the workforce on these projects be Iraqi nationals. But there are reports that these rules are not always enforced, with local workers being relegated to lower paid roles. This could create long-term dependency instead of a sustainable, skilled local workforce, which might be the highest price of all. All market data is subject to change. This content is for informational purposes only and does not constitute investment advice. We just saw how new players are rewriting the rules in the energy sector. Now, let's look at how a new kind of technology is rewriting the rules of customer service, and not always in your favor. Imagine getting hit with a $500 charge from your hotel, not because you were smoking, but because an AI sensor mistook your hairdryer for a vape. The situation presents a fascinating duality. On one side, this technology promises precision, but on the other, it exposes a huge legal grey area. When an AI makes a mistake like this, who is liable? The hotel? The software company? Or you, the customer, who now has to prove your innocence? Legal experts say both the AI developer and the business could be held responsible, but the burden of proof often falls on the consumer, creating a real headache. This isn't a hypothetical. It's the new frontier of what experts are calling algorithmic auditing, and it's quietly creeping into the services you use every day. The trend kicked into high gear with Hertz, which now uses AI scanners to detect every single scratch and dent on its rental cars, automatically generating a bill. The company says it's about creating precision and transparency, noting that out of 500,000 rentals scanned, over 97% showed no billable damage. From a business standpoint, this isn't just about fairness, it's about massive cost savings. Research from McKinsey shows this kind of digital transformation can slash a company's claims expenses by up to 30%. And a Deloitte study found that AI fraud detection can reduce incidents by 65%. So while it's presented as transparency for you, it's also a powerful economic tool for them. But the rabbit hole goes deeper. This technology is creating what one business professor calls a fundamental tension between operational efficiency and customer satisfaction. The dialogue is changing. Forget arguing with a manager. Soon, the final word might just be, the machine says. The real consequence of this shift, when you remove human discretion, you often remove empathy. A recent survey found that nearly 70% of people feel that AI systems fail to recognize emotional cues like frustration. We're trading the potential for a little human grace for cold, hard, and sometimes flawed algorithmic rules. And if you think this is just about rental cars, you're wrong. The tech is already here for hotels to use computer vision to spot wear and tear in your room. Now, get this, it opens up a huge can of worms around privacy. In a hotel room, we have a reasonable expectation of privacy. Legal frameworks like Europe's GDPR and state laws in places like California have strict rules against unauthorized surveillance. The question becomes, who audits these AI auditors to make sure they aren't crossing a line from damage detection into invasive guest surveillance? The next step could be restaurants using AI to itemize your plate, ensuring every last bite is billed correctly. So the thing is, on a technical level, the core conflict is whether an algorithm can understand context, the difference between normal use and actual damage. Can it distinguish a scuffed tire from a real problem? To train an AI for this, the auto industry has massive, carefully labeled data sets of dents and scratches, but the hospitality industry doesn't have a standardized data set like this. So the company programs a threshold for damage, and it's a subjective line that the AI can't question. While some call it a move towards accountability, one tech CEO calls it absolute overkill. He says this isn't about increasing efficiency, it's about using AI to suck extra money out of guest experiences. The battle between corporate automation and your wallet has officially begun. Speaking of AI, while some companies are navigating its legal headaches, others are absolutely capitalizing on the financial boom. Get this. One of Wall Street's top analysts, a pro who is reportedly right 73% of the time, with an average return of nearly 27%, just raised his price target on a key data security player. The analyst is Shrenik Kothari from Baird, and the company is Varonis Systems. Varonis just delivered a clean beat and raise across the board, blowing past expectations on revenue and cash flow. But what really brought this to a head was the company's transition to a cloud-first SaaS model, which is happening at lightning speed. SaaS revenue jumped from 61% of the total to 69% in just one quarter. The company is now on track to exit 2025 with an 82% SaaS mix, far ahead of schedule. The timing for this is crucial. As companies rush to deploy powerful AI assistants like Microsoft Copilot, they are creating brand new, unprecedented security risks. Think about it. These AIs have access to huge amounts of a company's internal data, and if permissions aren't perfectly configured, they can accidentally expose sensitive information. And believe it or not, this isn't a theoretical risk. One recent study found that over 4% of prompts fed to generative AI contained sensitive corporate data. This is why Varonis is getting so much attention. Their technology is specifically designed to tackle these new AI-driven vulnerabilities. And if you think that's the only AI-powered play turning heads, you're not alone. Take ServiceNow. After posting stellar results, a top analyst at TD Cowen didn't just reaffirm his buy rating, he raised his price forecast to a staggering $1,200. His reasoning? He calls ServiceNow the best positioned software company to monetize generative AI, noting its AI suite is driving bigger deals and faster growth. Behind that confidence is a brilliant strategy. ServiceNow isn't just plugging in a third-party AI. They've introduced premium add-ons like their Pro Plus package, which can command up to a 60% price increase. And customers are paying it with adoption rates hitting 55%. This proves businesses are willing to pay a premium for AI that delivers real value. To build a durable advantage, ServiceNow is also re-architecting its whole platform with its own specialized language models, creating a powerful moat that competitors can't easily cross. This all points to a massive battlefield. The database market alone is worth over $100 billion a year. And in that arena, another company, MongoDB, is being called a potential winner. This is where the situation takes a more complex turn. Generative AI runs on a different kind of data. Traditional databases are great for structured information, like spreadsheets, but AI needs to work with complex, unstructured data stored as something called vector embeddings. This has created a gold rush to dominate vector search. Instead of forcing customers to a new database, MongoDB is integrating this critical capability directly into its popular Atlas platform. This makes it cheaper and easier for companies to build AI applications, giving MongoDB a huge strategic edge in that $100 billion market. The bottom line is clear. While the broader market navigates uncertainty, a handful of elite analysts are placing their bets on companies they believe can dominate the new AI-driven economy. In a market searching for direction, they're pointing to a new class of potential titans. Disclaimer: this content is for informational purposes only and does not constitute financial or investment advice. All stock performance and analyst ratings are subject to market volatility.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.